The U.S. federal budget, since the end of World War II, has seen the defense portion consistently account for between 15% and 30% of total discretionary spending, totaling over $20 trillion in nominal terms. In 1944, war expenditure peaked at 37% of U.S. GDP. From the Spanish-American War to the conflict in Afghanistan, every major military action has generated highly asymmetrical financial returns, with zero public exposure to the operational risk. The paradoxical relationship holds: the greater the political instability requiring military intervention, the greater the concentrated, predictable capital accumulation by a highly defined non-public cohort. This is not about contractors selling boots. This is about structural control over the flow of state capital into manufacturing, logistics, and resource extraction. This is the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. The battlefield becomes the balance sheet, consistently enriching the same 5 structural beneficiaries. To understand this, we need to start earlier. The initial pattern of war profiteering was established not during the massive conflicts of the 20th century, but during the rapid industrialization following the U.S. Civil War, and culminating in the Spanish-American War of 1898. This era marked the transition from decentralized military supply to centralized industrial-scale procurement. Prior to this, military contracts were dispersed. The shift created the structural opportunity for concentration. The Civil War itself saw fortunes made through textile supply, railroads, and the nascent steel industry, establishing the early dominance of the infrastructure and raw materials providers. The Spanish-American War, a brief but strategically critical conflict, formalized the BAST, financial family, Type 1, the raw materials, barons. This group controlled the foundational inputs necessary for modern warfare: steel, coal, copper, and timber. Figures like Andrew Carnegie, though focused on steel and the associated coal and iron ore miners, saw demand accelerate dramatically. A war requires munitions, ships, and heavy infrastructure, all built from these primary materials. The profits were immense and predictable because the buyer, the U.S. government, was an unlimited budget client operating under urgency, eliminating price sensitivity and competitive bidding rigor. The numbers told a different story than simple patriotism. The price per ton of steel often saw a $5 to $10 premium immediately upon the declaration of conflict. This was the real shift. The next evolutionary leap came with World War I, transforming the American economy into the arsenal of democracy and introducing financial family. Type 2, the munitions and ordnance manufacturers. The war demanded an unprecedented quantity of specialized, high-explosive ordnance and chemical agents. Families who owned the core intellectual property and production capacity for smokeless powder, like the DuPonts, became indispensable. Their production facilities were converted entirely to government orders, offering guaranteed demand, government-backed financing for expansion, and protection from market competition. This established the model: secure a near monopoly on a critical, high-margin, war-specific product. DuPont's stock price, for instance, saw multi-100% growth during the 1914-1918 period. Their profit margins were protected by their unique ability to scale high-risk, high-specification chemical manufacturing. World War II magnified this pattern to a truly systemic level. The total mobilization of the U.S. economy solidified the role of financial family. Type 3, the heavy platform integrators. These were the families who controlled the corporate entities capable of designing, manufacturing, and delivering complex, large-scale systems: aircraft carriers, heavy bombers, like the B-17 tanks and jeeps. Corporations like General Dynamics, Boeing, and their component suppliers became state assets in all but name. The key was not the sheer volume of contracts, but the shift to cost-plus contracts, where the government paid the total cost of production plus a guaranteed fixed percentage profit. This structure eliminated the risk of inefficiency or cost overruns for the producer while guaranteeing immense returns on high-volume production. Confidence became currency. The families behind these corporate structures secured perpetual financial stability, using the war effort to expand capacity that would later transition seamlessly into the Cold War complex. The emergence of the Cold War and the Korea-Vietnam conflicts introduced financial family Type 4, the strategic technology and electronics providers. As warfare moved into the air, space, and electronic domain, the families who controlled the specialized componentry, radar, early computer systems, guidance technology, and communication encryption became essential. This group often operated invisibly, providing microchips, advanced composites, and sensitive electronic assemblies. Their profits were derived from the exponential markup on specialized R&D, often funded entirely by the government but privately owned. This established a closed loop where government-funded innovation became private profit. The numbers demonstrated an incredible return on invested capital because the government absorbed the R&D failure rate. Finally, the post-Cold War conflicts, culminating in the Gulf Wars and the War on Terror, saw the rise of Financial Family Type 5, the global logistics and services providers. With the military moving from fixed bases to highly mobile, dispersed global operations, the complexity of moving fuel, food, and maintenance personnel became a massive profit center. This group controlled the non-combat essential but mission-critical supply chain. They often secured long-term, non-competitive contracts for services, ranging from dining facilities to armored transportation. These contracts, totaling billions annually, provided a stable, annuity-style income stream, essentially monetizing the logistics of perpetual conflict. The historical pattern shows a consistent, 5-part division of the war finance pie: raw material, direct munitions, heavy systems, strategic technology, and non-combat logistics. The modern mechanics of war financing function as a sophisticated structural mechanism for capital transfer from the public treasury to these 5 specific entrenched private groups. The system currently works through institutional incentives and all liquidity dependencies that guarantees perpetual revenue. The raw materials barons, Type 1, now operate through global commodity and mining corporate structures, benefiting directly from geopolitical conflict that constricts supply. The war in Ukraine, for example, caused immediate and sustained spikes in the cost of nickel, aluminum, oil, and natural gas. The families controlling the extraction and processing of these resources realize massive untaxed inventory gains. Their revenue is not tied to the outcome of the war, but simply the fact of the conflict and the resulting commodity volatility. This is a pure structural hedge against stability. The munitions and ordnance manufacturers, Type 2, have evolved into the specialized small arms, precision-guided missile, and high-tech ammunition producers. Their current financial stability is guaranteed by the global arms market's rollover risk dynamics. Every major platform, jet, tank, ship, requires constant resupply of ordnance. A $100 million jet requires annual missile and bomb purchases that guarantee decades of revenue streams for the Type 2 families. The U.S. has sold over $1.5 trillion in arms since the late 1990s, locking in long-term procurement lines that bypass the annual congressional budget process through foreign military sales, FMS. This creates an annuity for the producers. Confidence decides who survives. The heavy platform integrators, Type 3, are now the major aerospace and defense primes. Their financial architecture is based on the refinancing dynamics of long-cycle programs. Programs like the F-35 Joint Strike Fighter, with an estimated lifetime cost of over $1.7 trillion, are designed to last for 50 years, ensuring multi-generational revenue. These contracts are secured through intensive lobbying. Total defense lobbying spend has averaged over $100 million annually for the last 2 decades, which secures Pasums mit Power asymmetries types. In procurement decisions, the illusion holds until it doesn't. The government cannot afford to let the prime contractors fail because they are the sole source for critical national defense assets. This institutional interdependence forces continuous capital injection, regardless of platform performance or budget constraints. The strategic technology providers, Type 4, benefit from the massive, sustained investment in cyber warfare, space systems, and artificial intelligence integration. Their profits stem from the high yield structure of government contracts, which often include high-margin maintenance and data services. This group often involves former government and military figures who move through the revolving door, securing classified contracts due to privileged knowledge of defense requirements. The key is to control the small, indispensable hardware and software component, not the entire platform. This asset has the highest profit margin, as the government bears the development cost, and the private entity owns the licensing rights. The Department of Defense requested $145 billion in R&D funding for 2024, a vast reservoir of capital feeding this cohort. Finally, the global logistics and services providers, Type 5, continue to extract profit from the necessity of outsourced operations. During the wars in Iraq and Afghanistan, this sector received contracts exceeding $200 billion. The modern version involves providing satellite communications, private security details, and complex maintenance globally. Their revenue streams are exceptionally stable because they are essentially utility providers for the military. The incentive structure ensures that every time the military reduces boots on the ground, the reliance on, and the spending on, private service contractors increases proportionally. Markets enforce what politics avoids. The operational expense is simply transferred from military personnel costs to private contract costs, and the profit margin goes directly to the controlling families. This ensures that even when a war formally ends, the financial commitment to the structural beneficiaries persists. The contemporary state of the war profit pattern is defined by its deep integration into the U.S. political and economic infrastructure, making it virtually inseparable from routine governance. The central mechanism is the creation of crisis triggers that justify massive, non-discretionary spending outside of normal procurement cycles. The Type 1 raw materials families leverage trade wars, sanctions, and resource nationalism to secure price advantages. For example, any attempt to limit energy production in specific regions immediately de-risks their own holdings by boosting global prices, directly increasing the profit margin on every barrel of oil or ton of copper they extract. Their power lies in the fact that their product is a non-substitutable input for all other war profiteering types. The Type 2 munitions families ensure their financial perpetuity through continuous, incremental technological upgrades and the strategic distribution of their manufacturing footprint. They actively fund political campaigns and think tanks that advocate for a high level of strategic inventory. The argument is always that the U.S. must have enough precision munitions, ready to use, for 2 simultaneous large-scale regional conflicts. This political argument mandates the perpetual filling and refilling of the defense pipeline, ensuring guaranteed purchases of $10 billion to $20 billion annually in specialized ammunition, regardless of the actual conflict level. The incentive is structural. The financial benefit is continuous. The Type 3 heavy platform integrators have perfected the art of institutional capture. They operate in a duopolistic environment where the failure of one firm, Boeing or Lockheed Martin, would constitute a national security risk. This dynamic makes them too big to fail by design, allowing them to dictate contract terms, delay deliverables, and continuously renegotiate cost overruns, all of which lead to higher profit margins, funded by the sovereign treasury. Their financial survival is guaranteed by the state's existential dependence on their specialized engineering capacity. The result is the monetization of inefficiency. What cannot be repaid will be rolled over. The Type 4 strategic technology providers are the new frontier, capitalizing on the shift from kinetic warfare to information dominance. Their wealth is generated by the asymmetrical profit from public-private research partnerships. The government pays for the basic and applied research for things like next-generation satellite communications or hypersonics. The private family entity then retains the commercial licensing rights, allowing them to sell the derived high-margin technology to commercial clients or allied nations. This is the definition of a risk-free profit model, where the government assumes the risk and the private entity claims the reward. This cohort's lobbying power is focused on budget lines that are obscure, classified, and difficult for non-experts to audit, ensuring minimal public scrutiny. Finally, the Type 5 global logistics and services families exploit the white power asymmetry between the need for speed in a conflict zone and the need for fiscal prudence. These companies charge exorbitant rates for basic services like fuel delivery and catering in remote operational theaters, citing high-risk premiums. The government pays because the alternative is mission failure. The long-term contracts for base maintenance, fuel supply, and infrastructure repair become steady cash cows, insulating these families from economic recession or market cycles. Their profits are a direct function of the complexity and duration of global military presence. The entire structure is a closed-loop system. Geopolitical tension justifies spending. Spending flows predictably to 5 structural beneficiaries, and their subsequent lobbying ensures that the tension remains structurally high. This is not capitalism. It is a system of state-guaranteed perpetual capital accumulation built atop the national security budget. The only thing certain in this economic framework is the continuous enrichment of these entrenched interests. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.